Startup funding, according to Crunchbase, has increased or at the very least remained the same over the last quarter. If you look at the charts they use here, down here closely, you'll realize this is Q2 2021 and this is Q3 2021. And up here in the chart, you see that this Q2 remains almost at the same level as Q3. It has remained high, but at the same time, you can see that it has remained stagnant. Now, but if you look from Q1 as well, I mean, the growth has been very slim in between these two, but from last year, it's pretty good. Now, note that last year there was COVID-19, so this is artificial. This is an artificial decrease. So it will be interesting to see what 2019 looked like. Let's go through the article itself and see what they say. The startup funding party is still raging. North American venture capital investment held up at near record-setting levels in the third quarter, as both early and late-stage deal-making remained on fire and big exits accumulated. That's good. Overall, investors put $79.6 billion, so about $80 billion, into the markets. So to work across all stages from seed through technology growth, according to Crunchbase estimates. That's just a hair shy of the 80 billion total for the prior quarter and the second highest total on record. So in reality, this is actually a slight decrease, right? And if you look at this as a curve, then this curve may be beginning to go down. But this is just a quarter over 4 months, 3 months. So this doesn't say a lot just yet. Now, to put this in perspective, the chart below tallies total investment color-coded by stage over the past 7 quarters. The blue is the angel seed. That's this. So angel is still the lowest expected. Early stage here, early stage increased over the first quarter, and has remained the same largely over the second and third quarters. And technology growth companies, so late stage have received a bulk of this, and technology growth companies have received a sliver of investments as well. Although investment totals stayed lofty, round counts ticked down considerably in Q3 as investors piled bigger sums into fewer companies. Along with giant rounds, investors also partook in some massive exits in Q3, led by public offerings by Robinhood and Toast. Below, we take a closer look at funding dynamics for the quarter, most of which are a continuation of ongoing bullish trends. We'll start with a look at funding stage by stage, followed with a summation of exits, including both public offerings and M&A. Note also that right now, the Fed has artificially lowered the interest rates. So it's expected that both for loans and for investments in this capacity, you'll see an increase in both, right? Because the interest rates are low. So people have more incentive to invest their capital rather than save it. Late stage accounts for the majority of startup investments, so we'll start here. Investors put in $50 billion into late stage venture and technology growth deals in the just ended quarter. That's on par with the prior quarter, but marks a gain of nearly 60% over Q3 of 2020. Round counts, meanwhile, ticked down a bit from the prior quarter. In all, 444 US and Canadian companies raised late stage or tech growth rounds in Q3. That's down 8% from Q2 and up 23% from year ago levels. Again, year ago levels don't say a lot in this situation. A year ago, we were in COVID and there were lockdowns almost everywhere. So the economy was artificially slowed down to help recovery in COVID. So this in of itself doesn't say a lot. But a better comparison would be comparing this to 2019 levels before COVID hit. We lay out more detail on investment totals and round counts for the past 5 quarters in the chart below. Here we see total dollars invested here, 31.8 billion. This is Q3 20, Q4 20. I expect these to be low. And from here you see where the recovery began, which was Q1 after the vaccines came out. And you see its continuation, but then it begins to come down, which is concerning because at this point the economy should still be firing on all fours, right? Because there was an artificial slowdown and now there's a recovery. So the recovery should last a lot longer than this. For Q3, a few really giant funding rounds played a big part in pushing up late stage totals. The largest round this past quarter went to electric vehicle maker Rivian, which pulled in $2.5 billion in pre-IPO funding. $2.5 billion in pre-IPO funding. Shortly followed by filing to go public. Other major funding recipients include AI-enabled data analytics platform Databricks. If you bought shares for any of these companies after they went public, let me know in the comments section. I know that this one we're about to read here. So let's say, which landed 1.6 billion. Online banking provider Chime, which raised $1.1 billion, and fast delivery service GoPuff, which secured $1 billion. If you bought, especially for Rivian, if you bought shares for this, let me know how this share value is doing. Right now, the market should be doing pretty well. Shortly followed by filing to go public. Other major funding recipients include AI-enabled data analytics platform Databricks. All right, we've read these already. Let's come down to early stage. Now, early stage funding was also on a tier in Q3. Over the past quarter, investors put $26.3 billion into early stage deals, Series A and B. That's about on par with the record setting per quarter and more than double a year ago. Round counts clocked in at 1038 for Q3. That's down from the previous quarter, but still marks the second highest total in the past 5 quarters. This is not a good metric. They should change this because this is a bad comparison. We lay out more detail on early stage deal making for the past 5 quarters in the chart below. Now, the only upside of using this chart, meaning from Q3 20 till now, is that it shows the economic recovery, right? So if you're a startup or a founder that's thinking of starting a startup, then this is encouraging. You are encouraged to start your business now and to look for funding, even though a lot of funding goes more into late stage and growth companies, but it's still an indicator that the market and investors themselves are feeling more confident about the future of the economy. If you want to start a company, now is a good time to do it. That's the good thing about this chart. That's what this chart explains. But apart from that, it's not good for much else in terms of the total amount or the comparative growth. So we've read down here. Let's go to exits. Investors weren't just piling money into startups this quarter. They were also generating some big returns as portfolio companies exited either through public market debuts or acquisitions, public offerings. Major public market debuts in Q3 came in a variety of forms. There were traditional IPOs, direct listings, and also a few big offerings for companies opting to go public through a merger with a blank check acquirer. Below, we look at 7 of the biggest debuts of the quarter, looking at initial valuations as well as the listing types for going public. So Robinhood went public. I didn't have shares in Robinhood, even though I use Robinhood. So that's one. Warby Parker as well. That's an interesting company. And then we see others: Toast, Ginkgo, Blowworks, Freshworks, Amplitude, Joby Aviation. All right, let's scroll down. And mergers and acquisitions. This past quarter was unusual for private company M&As. The largest anticipated deal, Zoom's planned $14.7 billion acquisition of contact center software provider Five9, fell apart a couple of months after it was announced. I should do a video on this. Then the biggest still pending tech deal, Intuit's $12 billion purchase of email marketing provider MailChimp, didn't make any money for private investors. Extraordinarily, MailChimp managed to bootstrap its way to that lofty valuation. I'm a big fan of bootstrapping. Now, investments are a shortcut. They help you get to where you need to get to faster, especially if you're able to figure out the market before you run out of money. But there's something to be said to actually figuring out the market itself, meaning how you'll make money, how you'll create your product at a low cost, how you'll make money on the other end, meaning get paid for it, and how you'll make profit in between those two numbers. There's something, it's a lot more difficult to do that. And the downside is many times you don't have the luxury to pivot as much as you would if you had funding. But at the same time, you're not using investor funds that could just get wasted at the end, right? If your goal is to get wealthy quickly, the investment round is the best, because when you're bootstrapping, you're scrapped for cash, but at the same time you learn a lot of things faster, because what you can't do with money, usually you can learn how to do it, like technical skills, for instance. So let's scroll down and Q3 plus military. Okay, the big picture. We can sum up Q3 venture investment and exit activity in a few words. Things are still looking bullish. Sure, we can find some negative indicators in development. A market sell-off has wiped out about $75 billion of the value of companies that went public using SPACs. Several prominent venture-backed companies, including 23andMe, Hippo, and MetroMile, have been amongst the hard hit. I'll make a video explaining what SPACs are and why they became popular recently. The quarter's largest traditional venture-backed IPO, no-fee stock and crypto trading platform Robinhood, has also had its ups and downs. Shares spiked a few days after the market debut, giving up most of the gains in subsequent weeks. Still, overall, things are going gangbusters in the startup sphere. That includes big rounds, big exits, and plenty of cash, rich funds sitting on the sidelines ready to invest. Certainly, this part is not getting started. It's been raging for a while, but it's definitely too soon to say it's winding down. That's not what the chart shows. The chart shows the opposite. The data contained in this report comes directly from Crunchbase and is based on reported data. Data reported is as of October 5th, 2021. Crunchbase usually has very good statistics, so that gives me confidence. Note that data lags are most pronounced at the earliest stages of venture activity, with seed funding almost increasing significantly after the end of a quarter or year. The most recent quarter year will increase over time relative to previous quarters. For funding counts, we notice a strong data lag, especially at the seed and early stage, by as much as 30 to 40% a year out. Now, these are just the important things that I wanted to state here. We don't need to go through everything. But the point of this article is to say that basically the takeaway here would be that the economy is recovering. Investors are more confident than they ever were that the economy is recovering. And now is the time to start a business if you want to, or look for external funding if you want to. Now, if you are one of the earlier stage companies, which is an angel seed companies, which is the companies that my videos are usually tailored to, then as expected, you get the least amount of money in the overall, but at the same time, you're also the riskiest companies. So what you would take away from this is simply that people are more confident in the markets. So if you go out there to look for seed funding, or you look for friend and family rounds, you're more likely to get it than you would have last year, just because the markets are recovering. Thank you guys for watching, and I'll see you guys in the next video.